Good afternoon, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hope everybody made it through the day okay. And today's markets, guys, well, it was an absolute destruction, of course. Take a look at this. S&P 500 slides 2%, the worst day since 2022, as Magnificent Seven sheds almost $800 billion in combined market cap. Yes, you would have to go back to December of 2022 to find a day where the S&P 500 fell over 2%, and the NASDAQ as well, down over 3.5% today. That was one of its worst days since that same period of December 2022. And we've kind of been warning about this on the channel, guys. It all started a few weeks back when we put out this one, cracks starting to form. Is there maybe a bigger pullback coming? That was cracks in the AI narrative and in semiconductor infrastructure dominance over the entire markets. And that was really accentuated when we got the CPI report 2 Thursdays ago, which proved very, very nice for just inflation coming down as a whole, but it really put in motion this rotation out of big tech, which was more a defensive play for a lot of Wall Street, and into more value names that have been beaten down by high interest rates, and also in small cap growth for that same reason, just because interest rates are going to be slated to come down in September rather than December. So a lot of Wall Street is front running that rotation trade. And we've kind of been hinting at this, guys, ever since the last week, right? Preparing for a larger sell-off. So it should be no secret to you that it has finally happened. However, if you were not prepared, do not worry, guys. It is not too late. In today's video, what I want to do after this introduction is we are going to get into, number one, the reasons for the sell-off right now, and number two, what can we possibly do as either long-term investors or traders to prepare for it adequately, right, and react to it accordingly. Now, after that, we're going to get into a few company earnings that I have prepared for you. So we're going to be going into, as promised, Coca-Cola, which had their earnings yesterday. We're going to be getting into Enphase as well, and then we're going to be getting into Chipotle, which was the big one after the close today. Tomorrow, since it's a more light day in terms of very large companies reporting, I'll probably be doing maybe UPS and maybe one of the defense names or something like that, trying and picking and choosing which ones we can do for the rest of the week. But tomorrow and Friday, since we don't have that many earnings to cover, I know there's a lot of earnings, of course, but in terms of the very big market moving companies, right? What we're going to do Thursday and Friday is put a special emphasis on trades and how we can position more specifically with either companies, ETFs, and how the sector rotation may be playing out. So we're going to be putting a lot of emphasis on the trading and investing side of things and positioning Thursday and Friday. No real need to get into it right away today here, guys. I know it's an important day, but in my humble opinion, this sell-off is not going to be one and done after one day. We will have a lot of time, guys, possibly a few weeks, up to maybe a month or more of potentially sideways or slightly downside correction. So a lot of time to be looking into those types of trades. Now, after we get into those earnings, guys, we're going to cover our major technical analysis rundown, of course, and our major indexes, and then dive into our big tech names and see whether or not some of them may be ripe to start a small buy the dip opportunity. So without further ado, guys, a lot to cover in today's video. Let's get right into it. SPY down 2.27% and QQQ down 3.6%. Extremely large numbers, of course. However, not everything was down, guys. Keep a special eye on your rotation. One of your major sectors was green today. And as a whole, guys, you did have a decent amount of names that were up on the day. You would think that nothing was up in the markets today, but actually 165 names were up, 336, the majority were down. The heat map looks something like this. Absolute complete destruction in the top half of the market. Big tech really falling off a cliff after Google's decent earnings yesterday, but we're not able to hold it up, 5% to the downside. All of big tech really taking a bath, and semiconductors really got the worst of it. A lot of names down anywhere between 5 to 8% as a whole. However, we also had earnings from Visa yesterday that were not well received by the market, even though we went through the earnings on the channel, and I deemed them to be perfectly fine. But as per usual, guys, you know how earnings go. Even if a company can have good earnings, the market can just say, we don't care. As a whole, financials down as well. Healthcare, one of the bright spots in the market. Energy and consumer defensives and utilities. Pay special attention to what was up today. Energy as well. This is essentially the value rotation that we were talking about one and a half week ago, and also into the whole Trump presidency narrative trade too, right? As I've been saying on the channel, it does not matter what side of the political spectrum you lean on, whether or not you like Trump, whether or not you don't like Trump. This game is all about narratives, guys. The market responds to narratives and tries to front run those narratives, even if eventually they may not be true. So a lot of time before the election, but we do have some positioning in these more defensive sectors, especially the ones that the presidential candidate Donald Trump is pushing for, right? So we have to pay special attention to the narratives always. Now, moving on here, guys, in terms of the one-day relative, you can see that even better. Yes, there was a few names that were a few sectors that were green on the day. Utilities, healthcare, defensives were slightly down, and energy. The worst components, of course, technology and anything under, especially consumer cyclicals, right? Think of consumer discretionary stocks, which have been hit pretty hard as well. On the 1 week relative, guys, everything pretty much down in the mud. Just focus on the ones that are least down. That is going to be the crux of the argument in the next maybe few weeks coming, right? But as a whole, everything pretty much moving to the downside, except for utilities, which is still having a nice little gain because it's responding to a potential rate cut in September. So moving on in, guys, let's get into a few reasons for the sell-off, right? And then we're going to get into exactly what we can do about it. So why are we currently selling down in a very accelerated manner right now? Well, we've been over this, right? Number one, the AI narrative is not translating into revenues fast enough. This was voiced yesterday by Google when CEO Sundar Pichai was asked directly by an analyst, what are the revenues that your AI infrastructure build out has given you so far? And he said, well, the revenues aren't really material yet. Yes, we have product efficiency improvements and cost control, but in terms of the revenue growth, it's just not there yet, right? So this has been one of the potential critiques of the AI narrative, and it's stemmed now for about the past 2, 3, 4 weeks. Number two, we obviously have election uncertainty, that famous rotation from big tech to value defensive, right? The reason for that, guys, is very simple. Number one, big tech was a very safe haven trade. When interest rates were high, people tend to flock to the companies with the most cash on their balance sheets that don't have a problem with debt, right? And that can still grow even despite high interest rates. And that, for the most part, was big tech. But now that you've brought forward a rate cut to the month of September, a lot of people are rotating out of that darling big tech trade and into everything else that's been left behind. Number three, don't forget, guys, we have a little bit of seasonality in effect. July is usually a very good month, but then we can see usually in the last 25 years, August and September really to the downside for the most part. We can even see this in election years. This is your S&P 500 in election years. Yes, I do agree here, guys. Let me move myself over. Usually we see a little bit of a run up in the month of August. However, as I was saying in yesterday's video, guys, the price action this year has kind of been jumped ahead by a couple months, right? This whole rally that we've had, in my humble opinion, that was late June and July. So maybe August and September is this consolidation, and we might not have that initial rally in August already. So keep that in mind. A little bit of conflicting data between usual years and election years. But in my humble opinion, guys, this correction could very well continue because we're coming in to a period of seasonal weakness as a whole. Now, moving on. Number four, technical correction, guys. That goes without saying. We were very, very overbought on a lot of the indexes, right? So take a look at this. Very overbought conditions in the month of July, big sell-off. Same thing happened here at the tail end of the month or at the beginning of the month of April. Big sell-off after overbought conditions on the SPY. And the same thing in the QQQ, right? Whenever we get too overbought on the weeklies, we can see these rapid form corrections, right? As they say, stairs up and elevator down. So a little bit of a technical correction underway after being so heavily overbought and streaking to the upside 9-10 weeks of growth of green in a row, right? Number five, big tech earnings de-risking. We saw it with Netflix and Google. We covered both of their earnings on the channel. I'm not going to include Tesla, guys, because Tesla obviously missed, right? But Netflix and Google did not miss. They missed on a tiny few little segments that should not matter in other market conditions. But now anything other than a pristine earnings report and pristine guidance is getting punished. So we have a lot of de-risking going on right now before next week's earnings, right? Just put yourself in the mindset of somebody looking at these earnings. Netflix has great earnings, down 3%. Google has fantastic earnings as well, and they're down 5% somehow. So obviously next week with Amazon, Meta, Microsoft, and Apple, AMD, so many other big tech companies, obviously there's a lot of speculation that even if they may report good earnings, they may just go to the downside, which is why you have some de-risking as a whole in a lot of big tech today, front running that potential sell-off next week off of good earnings. And number six, obviously, guys, the consumer spending recession worries that we've been talking about on the channel for about a month and a half at this point, but the results are mixed depending on who you ask, right? Obviously, we've had concerns from companies like Starbucks, companies like Nike, companies like, let's say, a Pepsi, right? However, on the flip side, you also have other companies saying, no, everything's fine, right? Costco reiterating that their consumer base is fine. American Express reiterating that their consumer base is fine. The major banks reporting that for the large part, consumer spending and consumer savings are quite fine. So very, very mixed results, which is what leads me into the next point, guys. The macro data is not bad just yet. We still have good GDP, we still have good jobs, and inflation is coming down. So until this consumer spending recession actually materializes through lower GDP output and lower jobs, and basically mean higher unemployment, right? And potentially a rise in inflation, which I'd be very surprised about because consumer spending is lower. Well, until this starts to deteriorate, guys, we cannot say that the sell-off is because of bad macro data just yet. So what are we going to do about all these things, guys? So I have a few key points that is going to be very, very crucial for all of us to understand and apply over the next coming 4 weeks. And I do this every single time that we get a very large sell-off in the markets. So number one, if you're a long-term investor, 5 to 25 years in the future, guys, it's extremely simple. Never sell ever. And I don't give financial advice on the channel, guys, but you can pretty much take this one to the bank. You guys know the statistics, right? Time in the market, it beats timing the market every single time. Never sell ever, guys. Ever, ever, ever. You should just be continuously buying the highest quality companies or ETFs. I'm never opposed to ETFs as well. Very good strategy too. And dollar cost average into them with your job income. It's the best thing to do to guarantee long-term wealth, guys. Do not get shaken out by short-term market movements. It's just not worth it. And then what you can do to protect potentially is sell 45 to 60 day to expiry covered calls, which are 10 to 20% above the current price. That should give you a decent buffer to get through this potential correction, which I do see maybe lasting as much as this time to expiry, and 10 to 20% above the current price, guys. Well, at least it's going to be so high that you may not mind being called away, but we want to avoid paying taxes here, right? So you don't want to get called away and sacrifice potentially very low cost bases. So take with this what you will. Now, if we're a trader, whether you're a day trader, which is pretty much intraday trades, a swing trader, so think of positions for maybe 2 to 5 to maybe 10 days, or a position trader looking to maybe pick the bottoms and ride trends for the next 2-3 months. Keep in mind, guys, these market events like this right here, extreme increases in volatility, this is when most people lose their accounts. Why? Because they do these 3 things. They chase the market to the downside, and then when they get a bounce, they get shaken out, and then it resumes to the downside. They try to chase it again, bounce, and so far, so on. Do not chase the market, guys. Let the price action determine your entries and your exits. You should always be selling on green, and you should always be buying in the red, right? So now, do not overtrade, number 1 rule as well, and do not revenge trade. If you've been affected in the past week and a half of trading, if you've lost a lot of money, guys, the worst thing you can possibly do is revenge trade and try and make it back all quickly. Stick to your strategy, be patient, do not chase the market, let the trades come to you, and just please, please, please respect your strategy. I don't care what you have to do, write your strategy on a piece of paper, write it on a Post-it, and stick it on your monitor. Do not deviate from the trading strategy just because we are having some very violent sell-offs right now. Number 2, never feel sell shame, guys. If your expertise is big tech and maybe consumer facing stocks and they're not favorable right now, and you just want to sell everything and sit on the sidelines, do never feel sell shame, guys. Nobody is going to shame you for selling out of a position. To be honest with you, it's your money. You can do whatever you want. It's all about your comfort level. So please do not feel any shame whatsoever if you feel the need to sell your positions and wait on the sidelines for all of this uncertainty to kind of get behind us for us to get some more established support levels on indexes or stocks, right? Number 3, follow the money. This is crucial for us traders, guys, right? Follow the money. Where's the money rotating? Home builders, good. XLV, healthcare are good. Defense corporations, Lockheed Martin, Raytheon are good. Real estate and utilities plays as well. Play the trends. If they are in daily and weekly uptrends and you like taking stocks to the upside, you're not that much of a fan of short selling the markets or something like that, then follow the money. It is crucial for you to have this chart open and see where the money is rotating on a daily and weekly basis. Now, whatever the expected move is, number 4, whatever the expected move is that you think the move is or that Wall Street says the move is, when the VIX VIX is this high, guys. Take a look at the VIX, right? VIX is absolutely skyrocketing right now. When we're in high periods of uncertainty, guys, you can pretty much take whatever the expected move of a stock is and at least 1.5x or double it. You can be certain of that, guys. It's going to throw us some curveballs. If Microsoft usually has expected moves of 4% in a given week, these types of weeks, they can move 5, 6, 7, 8%, and no one would be surprised. Manage the risk. Number one, always, guys. Cut down on margin and save buying power for A+ setups. Do not lose your account by trying to over leverage and trying to catch the bottoms every single time, guys. It's a very easy recipe to get destroyed. Now, number 5 or 6, whatever. Use 3 times leverage ETFs. Now, these are perfect for day trading when the VIX is high because calls and puts, the implied volatility, it's going to make them very expensive to trade. So you can get crushed, guys. A stock can potentially move in your direction, but because the implied volatility is so high, you may not get the desired returns that you want. That's why we can use 3 times leveraged ETFs for the plays that you want. You can do them bearish, you can do them bullish, whatever direction you want, but this is a great way to avoid getting absolutely crushed by implied volatility moving up on options. And now, number 8, take out the narratives, guys. Price action is key. Notice who is in control of the higher timeframes, daily and weekly timeframes, and go with that, right? If the SPY is in a daily downtrend right now, then every single lower high should be for selling, right? So don't try and go counter the trend. The trend is your friend. Take out all the narratives and focus solely on the price action in front of you. That is what is going to save you. So hopefully you guys appreciate that introduction. I know it was a bit of a long one, but I had a lot of things to say, obviously, because I understand the position that you guys are in. It is never fun being down money and a lot of money in a very short period of time, but how we manage these situations time in and time out is what's going to help us learn as investors and traders and prepare us for similar situations in the future, guys. I literally, since I've been trading pretty much back since 2015, 2016, I can look at these charts, guys, on the weekly timeframes and pretty much tell you every single reason for every single major drop, guys, right? And you will learn to do the same, and you'll quickly recognize it happens all the time. 5-10% pullbacks in the market are pretty much a buy or try annual thing. They happen 2-3 times a year. It's just normal, and how we deal with them moving forward is what sets us apart from the rest. So hopefully all of that makes sense. Now, with that out of the way, guys, let's get into our earnings cycle, shall we? So moving into Coca-Cola, we're going to run through these a little bit quicker than the ones yesterday, but still we're going to cover them appropriately. So Coca-Cola coming up nicely since their earnings yesterday, up about 1.31%, moving very well as a matter of fact. And what happened for Coca-Cola? They had a nice double beat, right? Traditional to their fashion. It's very tough to find Coca-Cola to miss one of their earnings. Now, beat on EPS by about 4.25%. They did have a nice beat on revenue by about 5%. Why do we look at Coca-Cola, guys? We're trying to get insights into the consumer. Pepsi said that there's a little bit of a slowdown, but because their business model is solid, they can pretty much weather the storm. Is Coca-Cola saying the same? Let's have a look. Coca-Cola tops earnings estimates, hikes full year outlook as global demand rises. So once again, Pepsi saying one thing, Coca-Cola saying something different, right? Well, Pepsi didn't say anything bad, necessarily. They're pretty much saying that they're rounding the corner in terms of consumer cyclicality, but here we go for Coca-Cola. For 2024, Coke now expects organic revenue growth of 9 to 10%, up from its prior forecast of 8 to 9. So they raised guidance. The company also raised its outlook for comparable earnings growth to a range of 5 to 6 from a previous range of 4 to 5. So revenue and margin expansion, pretty good for Coca-Cola. Our updated 2024 guidance reflects the momentum of our business in the first half of the year and our confidence in our ability to execute on our plans during the second half of the year, said the CFO. Net sales rose 3%. That's normal for Coca-Cola, guys. Do not expect Coca-Cola to have double-digit growth. If anything, they usually only grow their revenue about 3-4% per year at the most, right? Very, very defensive company at this point in time in the stage of their business, right? Now, moving on. So Coke's unit case volume rose 2% for the quarter, also relatively standard, helped by its international markets. But in North America, volume fell 1% for the quarter. Exactly what Pepsi said. International good, but at home, not so great, right? Coke said North American volume declined for its water, sports, coffee, tea, and trademark Coca-Cola and other soda brands, offsetting growth for its juice, dairy, and plant-based beverages. Coke's rival Pepsi reported earlier this month that the U.S. consumer has weakened, hurting demand for its own drinks and snacks. Here's what the Coke CEO had to say. He blamed weak sales in away-from-home channels for North America's declining unit case volume. Away from home, think restaurants, quick service restaurants, fast food chain, where Coca-Cola has a lot of positioning, right? Now, To boost demand, Coke is partnering with food service customers to market food and drink combo meals. Now, CNBC previously reported that Coke contributed marketing funds to McDonald's for its $5 value meal, which includes a small soft drink to make it more attractive to franchisees who can otherwise be wary of steep discounts. Coke's overall prices were up 9% with compared to the year-ago period, but about half of that came from hyperinflation in certain markets. Yes, but what about the consumer, Will? What did they have to say about the consumer? Don't worry, I went through the earnings call, so I have everything prepared for you guys. Here's what they had to say about the consumer in their opening remarks, and then we'll get into analyst questions. As we look forward to the second half of the year, the external backdrop remains uncertain, including some signs of pressure in various consumer segments across developed markets. A lot of people are saying the same thing, guys. However, thanks to the power of our portfolio and the unwavering dedication of our system employees, we are confident we will deliver on our updated 2024 guidance, longer-term commitments. Now for the analyst questions, and they had some good ones. So, here is what one analyst from Morgan Stanley had to say. It'd be helpful to get an update on North America, given questions around consumer spending. Can you just discuss any demand impact you're seeing on your business, any variance in channel performance, and how that informs your view going forward? Here is what the CEO had to say about that. Let's move it in. Let's move on right now. Yes, sure, no problem. First, it'd be fair to say that the consumer sentiment in aggregate is actually pretty strong and pretty resilient. Within that, there are some softer spots, I think, which has been relatively put out there already. Some softness in away from home channels. Think at restaurants, right? With a little lower traffic and some increase in value seeking for combo meals. So definitely, there's a piece of the lower income consumers which are either going out slightly or less, right? But when they do go somewhere looking for greater value through combo meals. And then, of course, in the at-home channels, there's a slightly greatest focus by those consumers on getting kind of value deals or promo deals. That is exactly what Pepsi had to say as well. People are hunting for deals necessarily. So the CEO noting there is some weakness, but not across all consumer demographics. Let's move on to a further question, shall we? So moving on again. Now, another analyst right here, this time from Jefferies. Hi, you delivered 2% case volume growth. And when we look across the store of the rest of consumer staples, we're seeing quite a bit of a slowdown in volumes. I think you're positive everywhere with the exception maybe of North America. What should we be looking at over the medium term in terms of volume growth? Here's what the CEO had to say once again. We've talked in the past. It remains true today that the central long-term growth algorithm, we're looking for a revenue of 4 to 6%. And we've set ourselves the ambition of staying in the 5 to 6% range with a balance of volume and price mix. Here's what this means. So that's essentially a way, if you split that, you're saying 2 to 3% growth on volumes. This is their entire revenue growth, right? How do they achieve 4 to 6% revenue growth? Half of it with actual volume growth, so supply numbers growth, right, to consumers, and 2 to 3% of that is price. So we're kind of in that range in the quarter with the 2% volume. So they're looking for, still to have a little bit of pricing power, but also looking to push a lot of volume too, right? So as a whole, guys, I went through a lot of these questions right there, and the answers were pretty much the same, right? Yes, there is some consumer weakness in certain demographics, but for the most part, Coca-Cola does not see any larger macro trends at play here. The lower income consumer is a bit weaker, but medium and higher end demographics seem to be doing okay. So quite mixed results from them. Now, in terms of Coca-Cola, guys, operating income, right? This is very, very good. Operating income grew 10%. That is fantastic. They're improving efficiency, right? Even though the volumes are not up as much as they should be. And then lower in the report right here, I just highlighted one other thing. I forget where it is. Let me see right here. I think it just erased itself. Anyways, all you need to know, guys, is they made about $3.5 billion of free cash flow during the quarter. So very, very nice. You saw it highlighted and then apparently it just vanished on me, right? So very decent free cash flow from Coca-Cola. Nothing bad about the company per se. And they do think that, as I was saying, guys, very, very mixed results in terms of the consumer. But overall, they don't paint a bad picture of the consumer. And you can see here, quarterly free cash flow usually ranges between 1.8 to about $4 billion. So for them to get about $3.5 billion this quarter, it's right in line with where they usually are. Now, in terms of Coca-Cola's valuation, because they are approaching the all-time highs, you obviously know this is Warren Buffett's favorite stock, and it's because they are such a defensive company. Company pays about a 3% dividend as well. So with relatively low revenue growth and relatively low EPS growth, fair to say that Coca-Cola is a more established, more value-oriented company. You can see that, guys. EPS growth, yes, it is growing, but it's not growing amazingly, right? Not double digits like a tech name. And revenue, even though revenue is growing, it's growing relatively slowly. However, the company is extremely well positioned still, and still one of the best names in the market for a defensive stock capacity. Now, in terms of their historical average PE ratio at $65 right now, the forward PE is about a 22.83. Historical norms for Coca-Cola in the last 4 or 5 years at this point have pretty much been around there, right? Low to mid 20s. So I don't see any problem with Coca-Cola's valuation in terms of PE. We can't really use the PEG ratio I put up here anyways, but we can't really use this, guys, because they're not really growing that much, right? They're more of a stable and maintained company. PEG ratio is more for a more growth-oriented company, right? What we usually use for more defensive companies is a metric called the free cash flow yield. It is pretty much what from one share of $65 per share, right? How much of that share price is pure free cash flow, pure profits to you, the investor, right? Some people use earnings per share, of course, but a nice metric is free cash flow. How much disposable cash does the company have to either pay back to you in dividends or buy back shares? That is what matters. And usually a free cash flow yield, guys, between 3.5% to 5% is what's tend to be good for an established company in an established industry, right? 3.5 to 5% is a sweet spot. Whenever you see lower than this, guys, either the company has a problem with free cash flow, but if it doesn't have a problem with free cash flow at all, and it's a solid company, it just means that the share price is too high. How you derive this calculation is very, very simple, guys. All you have to do is divide their trailing 12 months free cash flow. So you can even do it right here on TradingView if you want, right? Just take their free cash flow on an annual basis. You see right here, 9.75 billion, and just divide it by their total market cap, which is about 283 billion, right? It gives you the free cash flow yield. Very, very easy calculation. Just understand that anything between 3.5 and 5 is good. It means the company is fairly priced and can go a little bit higher. But anything under 3, 2.5, guys, starts to get way, way, way too thin. It means the company has run a lot, and maybe you are better off waiting for a pullback because there's not much value to be had potentially when a free cash flow is under 3%. So hopefully that makes sense, guys. I like Coca-Cola. If you're holding this one for the long term, I see no reason to sell. And even for starting a position for a long-term portfolio right now, free cash flow yield, very manageable. P ratio, very manageable as well. Pays a 3% dividend. Can't go wrong with Coca-Cola, guys, at all. It does appear that they finally want to embark on their breakout of this roughly 2-year range that they've been in, right? Looking for a very solid breakout on the long term. I'll remind you guys, there's a reason that this company's long-term stock profile looks like this, guys, right? It's because they do well in every single market, and they're a much better company, much more efficient company than they were back here. So I do think that Coca-Cola's gains will obviously continue to move on forward. You know, some years they'll underperform the S&P, some years they'll outperform, but usually they do outperform on a longer term basis, especially when you include the dividend yield. Now let's move on to company number 2, shall we? So company number 2 is going to be another one in the food and beverage industry, and that is going to be a big one, Chipotle. So Chipotle has obviously been having a number of problems since their stock split, right? They are pretty much down 25%. And this earnings was going to be whether or not that the concerns about growth the concerns about growth and valuation, were they justified? Or was the company still growing adequately? Well, suffice to say, guys, Chipotle did an amazing job for their earnings today. They just had a little bit of problems on their guidance, and we'll get into that. But this quarter, they completely destroyed it, guys. To be honest with you, they completely destroyed it. Now, earnings, nice little beat on earnings by about 7%, nice little beat on revenue by about 1%, and the long-term fundamentals and growth prospects of the company look extremely good. Very nice EPS expansion, very nice revenue expansion, and analyst targets well above the stock price. However, the valuation at these levels is my one and only concern with the company. Now, let's get into a few details about Chipotle, and then we're going to get into exactly what was said on the conference call. So take a look at Chipotle, guys. Chipotle earnings and revenue top estimates. Restaurant traffic rises again, and they completely crushed it, guys. Wait till you see the same store metrics. They were crazy. Now, saw higher traffic as its restaurants. Chipotle saw higher traffic, bucking an industry slowdown. We've seen the slowdown, right? From companies like Starbucks, right? Foot traffic was down. Companies like McDonald's as well, slightly down. Even companies like Walmart and Costco, even though their price per ticket, the total checkout bill was slightly higher, they're seeing less people shopping and people more discretionary on their purchases, right? So they're really bucking an industry trend. As of the Wednesday close, Chipotle stock has slid 17% this month, hurt by investor concerns about the health of the restaurant industry. So, Chipotle's profits rose from the year-ago profit due to price hikes that helped offset higher avocado prices and greater usage of oil to fry tortilla chips this quarter. Funny, right? Now, net sales climbed 18.2%. Massive. Company's same-store sales rose 11.1% in the quarter. Massive. Usually, guys, for fast food restaurant chains, right? Usually, a very good quarter is 5.5% to 6% over quarter growth, right? 11.1% is 2 times the best numbers you can possibly find in the industry. Crazy number for them, topping the estimates of 9.2%. Demand for its food. This is where the little bit of drawback comes in. Demand for its food peaked in April, said the CEO. Same-store sales settled around 6% higher in June. So a lot of that growth was in the months of April and May, but June down to about 6%. Executives said that July has been more difficult to understand given the 4th of July holiday, weather disruptions in Texas, and a recent tech outage. Traffic to its restaurants increased 8.7%, despite backlash on social media fueled by customers who said their burrito bowls are smaller. They're obviously referencing this article right here. An analyst ordered 75 Chipotle burrito bowls to test portion sizes, and his results were fairly mixed, right? Some were above the median, some were netly below, but as a large part, guys, the median was pretty much in line with everything. It's just, it wasn't standard across all 75 different restaurants, right? And that was a problem for the company, and they did address this. We have focused in on those with outlier portion scores based on consumer surveys, and we are re-emphasizing training and coaching around ensuring we are consistently making bowls and burritos correctly. We have also leaned in and re-emphasized generous portions across all of our restaurants, as it is a core brand equity of Chipotle. Restaurants' transactions grew across every income level. Crazy, right? Other consumer companies from Pepsi to McDonald's have said in recent months that low-income consumers are pulling back more, pressuring their sales. Chipotle, similar to many fast casual chains, benefits from a consumer base that tends to make higher incomes. So, Chipotle opened 52 new company-owned locations and 1 new international licensed location. The company reiterated its full-year outlook that same-store sales will grow by mid to high single-digit percentage. Chipotle also anticipates that it will open between 285 and 315 new restaurants this year. That is very good, guys. Company's growth story continues, and take a look at this, guys, right? So operating margin up 19.7% from 17.2. Not only are they growing, they're getting more efficient as they grow as well. 8% in transaction growth in the quarter, said by the CEO. That's very, very good. And the last thing I want to show you for Chipotle, guys, is the net margins. They don't really have a problem. I went through everything. You guys know I always do. I only bring you the highlights, right? So extremely efficient, guys. Revenues went up, but they were able to control costs very, very well. Gave them a net income of 15.3%, guys. That is one of the highest net incomes that Chipotle has ever had. Let me move myself over. Look at the past 5 quarters, right? 12, 13.5, 12, 11, 13.3, now 15.3. All years prior, they have never had margins in excess of 15%. So to see them at 15.3 is very, very good for the current quarter. Now, where is the problem, right? So here is the problem. And I went through the earnings call. I listened to it for 45 minutes, guys, just so you guys don't have to. So here is what they had to say on the call, which is one of the reasons, guys, that the stock, I apologize, didn't even show you the stock's price performance in the after hours, right? Chipotle, when they released their quarterly earnings, they were up massively because the numbers were so good. They actually went up 15% and gave it all back, almost ending up only about 4.5%, which is still good, but still giving up all that gain. Why did they give it away? Well, it all had to do with the earnings call, guys, and here are the highlights, right? So on the call, this was the tone, guys, cautiously optimistic. They understand what's happening with the consumer as a whole. Even though the company's not directly affected by it right away, they understand that the writing may just be on the wall, so they were cautiously optimistic, and that's what really hurt their share price in the after hours. CEO on the call, no more price hikes this year. And he literally said the consumer doesn't appear that they can afford it. There's a noticeable pullback in macro spend surveys. He didn't say for Chipotle sales. He said he's looking at a lot of surveys, and a lot of other companies are saying that the consumer is slowing down. Cautiously optimistic. Chipotle is not affected by it yet, but he's cautious, right? And Number 2, they expect margins to be under pressure on the next few quarters. The business peaked in April and May, and June and July were a little bit weaker, right? So they expect margins to be under pressure, which is why this 15% number right here may just go down ever so slightly, guys, as they contend with maybe the fact that they can't increase prices anymore, right? So if ever the cost of their goods, such as avocados, oil, stuff like that, if that keeps rising and they can't increase prices to the consumer, they have to eat those price increases for their products in the margins. That is why, right? And they said seasonal factors, consumer weakness possibly. Number 3, focus on larger portion size. We addressed that already because it's an integral part of their brand value. He was asked about this by analysts and he said, yes, we are training and whatnot. Restrained and retrained and coached for portion sizes, and he highlighted once again the 8% transaction growth. So all in all, guys, that is the summary of the earnings call. Nothing more than that, just the major points. In all, guys, Chipotle is growing excessively well. 12% revenue growth year over year. EPS growth 22% per year, which gives them a valuation right now at about $53, a PE ratio of about 47.3. A little bit pricey, but when we divide it by their EPS growth, it gives them a 2.15 PEG ratio on the forward basis, guys. This is still relatively expensive. I would be a bit cautious moving into this one, guys, just as the company said, cautiously optimistic about Chipotle. Are they growing well? Absolutely. But we cannot forget that consumer weakness is front and center for the company. So this high of a valuation with these concerns, right, is maybe not the best value proposition for the company. Chipotle really becomes a better value, guys. And I know this number is going to sound low, but that's just where I prefer the company. I had a position leading into earnings. I closed it prior to earnings, guys, because I kind of saw the writing on the wall. I knew they were probably going to have a solid quarter, but I was worried about the guidance. My only time that I'm going to probably be buying Chipotle once again, guys, is when we get back in maybe the $46 all the way down to about $40 range. That's when the valuation becomes a lot more manageable. Do not forget, guys, this is not a tech company. It is a quick service restaurant. For it to be trading at 2.15 PEG, guys, that is extremely, extremely elevated. I would like to see this more back in line with maybe like 1.6, 1.7 at the most, and that would be that extra decline of maybe another 20%. So I don't want to see it happen for all of you Chipotle investors out there. I'm just saying where I would be more comfortable buying the stock and be more confident in this valuation. So I'll keep this one on a very close watch. I had positions up here. I closed them for a loss. I'm just not willing to take the risk on this one specifically. Even though it's a very good company, we have to understand the larger macro things at play here, right? So moving on, guys, let's cover company number 3, and we're going to do this one relatively quickly as well. Sorry for the longer video. I know you guys have told me that you like the longer videos, and I appreciate your feedback so much, but still, right? Let's move on to Enphase right now. So Enphase, what happened to Enphase after the earnings today? They were up at one point almost 15%, almost ending up 13% on the day. Why though? They absolutely missed everything. So this is hilarious, right? Companies like Netflix and Google can pretty much beat almost across everything and be hugely down. And a company like Enphase, which literally missed every single metric possible, well, they are up 13%, which is why I say, guys, earnings is always a toss-up. They missed on EPS by about 13%, missed on revenue by about 2% as well. But we know this, guys. It's no surprise here, right? Enphase has been pretty much down in the dumps ever since the hike in interest rates. That's pretty much crushed their demand by 50%. Their revenue right now is 50% lower than it was just a few short quarters ago. Take a look at your revenue, right? Revenue about 5 quarters ago was about $711 million, and it's only about $300 million right now, more than halved, which is why the stock price also has followed suit, right? So no problem there. What we're trying to figure out for Enphase is it time to buy this one for a turnaround story with interest rates coming down in the near-term future? So let's take a look at Enphase earnings, shall we? So Enphase stock is rising. Analyst sees a light at the end of the tunnel. Let's get into it. So the solar and battery system suppliers' commentary about the future gave investors reason for optimism in a difficult environment for solar companies. Enphase has turned a corner, said the CEO. Last year, solar demand slumped. Enphase was shipping too much equipment to the distributors it works with to sell its products to consumers. Inventory piled up, and Enphase's sales plunged. However, now here we are. In the second quarter, though, the distributors were able to sell off the old inventory. Now the channel has drained, said the CEO. We are going to manage it to always have a balance between sell in and sell out, so managing inventory a lot better. Enphase's sales are still well below prior levels, and it could be a little while before they return to their previous cadence. In the first half of 2023, the company's sales were running at a rate of about $700 million per quarter, which we just saw. The company expects third quarter revenue of $370 million to $410, a lot better than last quarter of about $300. That is, however, below the Wall Street estimate of $412. So they even missed on guidance. They missed on current numbers, and they even missed on guidance. So why the bullishness? Well, here we go. The CEO said that persistent high interest rates are hurting the business. Consumers are less likely to make big purchases like solar roofs, which can cost upwards of $20,000, which they have to finance. The company's U.S. business, which accounts for a majority of its sales, is nonetheless showing signs of a turnaround. Enphase is ramping up its U.S. manufacturing in response to government incentives. The Inflation Reduction Act, put forth by the Biden administration, has enabled us to manufacture in the United States, supporting jobs and advancing the country's renewable energy economy. Improvement in the U.S. market, specifically in California, is a light at the end of the tunnel. The key takeaway, in our view, is that the California market is stabilizing and should be viewed by investors as nearing an inflection point, especially if a September rate cut generates additional tailwinds for solar installs. Now, interest rate cuts are expected to begin in September, which will be a positive move for the industry. However, a Donald Trump presidency would be expected to be negative for the clean energy industry because the former president has been open about his distaste for the IRA, talking about the Inflation Reduction Act. Now, I'm not too sold on this idea of potential former President Trump, if he would to be elected, to be that hard on renewable energy sources. We all know his famous line, drill baby drill, talking about oil companies, of course. But the one thing that Donald Trump did not like about the Inflation Reduction Act, guys, he doesn't mind renewable investments, right? It's all the other stuff that they included in the bill worth several hundreds of billions of dollars, which he doesn't deem adequate. But to say that President Trump would not be in favor of renewable energy companies, I don't necessarily believe that to be true. I could be wrong, however, but I think they're putting, I think it's the way this article is written. My train of thought essentially is the way this article is written is kind of, it's playing it to be an all or nothing, right? I don't believe it to be an all or nothing scenario. Yes, there probably will be more favoritism towards oil companies and making America non-energy dependent from imports standpoint. However, to say that a Republican presidency would not give any funding whatsoever to renewable energies, I don't think that would be true, guys. Obviously, I could be proven wrong, but the way this article presents it to be an all or nothing scenario, I don't think it's that at all. I think it's a little bit in the middle, right? Maybe some 60-40 action going on here. Still, the improvement Enphase reported in the US and potential rate cuts seem to have fired up investors for now. So let's get into it here, guys. If you guys don't know what Enphase does, right? Well, Enphase obviously manufactures solar inverters. So when you have solar panels, those generate energy, but then that needs to be transformed into electricity. So essentially what happens is you have energy come in through the solar panels, and then it needs to be converted into actual electricity that you can then use to plug in your devices to and to power your home or whatever you need, right? So those are what's called solar inverters. The inverter is what does the conversion between the solar panel energies and the endpoint electricity to be used. Now, Enphase has been making very, very nice leaps and bounds in terms of what it can try and do, right? This is brand new for the company. They've been doing this for about almost 6 to 9 months now, and it's called smart energy management. If you're plugged into their grid, into their systems, it actually uses the rate of the grid right now to determine whether or not it should be using your in-house piled up electricity that maybe the solar panels put into a battery from Enphase and then use into your house, or whether or not it would actually be profitable for you to sell that electricity back to the grid. Very interesting right there, right? So they can export your power to the grid, or you can obviously use the power from your battery, and Enphase's AI algorithm determines when is the best time to do either one of those. So it's trying to minimize the costs for you, of course, or to make it the best option for you available, right? So that is pretty much something cool that I found in the earnings report. Now, obviously, they've improved their product lines as well. The potential per home is about $12,000. They used to only have inverters. Now they have batteries, and now they're adding on a bunch of extra things, EV chargers, AI software, everything you can possibly want, right? Now, let's take a look at some of the financials, some of the real highlights here, right? So quarterly revenue per year, take a look, guys. 2024 is your dark blue line. You'll see it's really, really below 2022 or 2023. That's normal. However, what we need to take an attention on, guys, is quarterly gross margins. We know the revenues are down, but how are their margins doing, right? Are they controlling expenses while revenues are going down? That is very important when a company is getting their demand crushed. So you can see quarterly gross margins are actually better better than they were in 22 and 2023. The companies have been doing a great job at managing the cards that they have been dealt, right? Doing a great job of managing their expenses, in other words, right? So let's take a look at this right here. Now, the quarterly operating expenses percentage by year, that is skewed. It just says a percentage of revenue, and I'll explain right below, right? So here's what we have to focus on in terms of Enphase, right? So let's take a look at the revenues, and you'll see, guys, this is all very, very simple, right? I don't want to spend too much time on this, but here's their revenues. You can see $500 million, right, per quarter, $700 million per quarter, and now it's down to about 350 million. But look at the cost of goods sold, right? Cost of goods sold usually moves in line with your revenue. It is variable costs, right? Obviously, if you produce more or you produce less rather, then your costs will be lower. And you can see, yes, the revenue has halved, but their cost of goods sold has also halved. So no problem there. We know that the variable costs are there. However, let's take a look at gross profit margin percentage, right? So gross margin is obviously either staying flat or slightly getting better. Why is that the case? Because the company is keeping their operating expenses flat. Operating expenses is anything that is not cost of goods sold. Think selling expenses, administration expenses, marketing expenses, stuff like that. Things you can control, right? And look, so you can see that they've done a great job of keeping these relatively the same. When they had high revenues, they kept the operating expenses the same. And now when the revenues are lower, they have actually decreased them ever so slightly, but there's only so much you can reduce, right? They were already operating very efficiently prior. And this is pretty much, in my humble opinion, the lower end of how much they can trim down expenses. So they've been doing a good job of keeping their expenses under control. The last thing you would want to see is revenues go down and expenses go up. So at least they've been doing a good job of managing their expenses, in my humble opinion, right? So Enphase, obviously, guys, has been getting crushed, and we've talked about this on the channel before. Even though interest rates are coming down in September, you could have some renewed interest in the stock, but to say that it's going to do like this is probably just wishful thinking, right? In my opinion, Enphase will be able to recover, but it's going to be a very slow recovery. Now, you could have some price action in terms of people trying to front run the interest rate cut, but that is not going to translate into excessive demand and sales for Enphase in a snap of a finger, right? Obviously, it's going to take some substantial interest rate cuts, probably into next year, to actually stimulate demand once again. So by the time we start to see revenues coming up again in a nice fashion, it's probably still going to take another 6 to at least 9 months, guys. So we have to be logical with our timelines here, right? However, usually Wall Street does run 6 to 9 months ahead. So I am considering potentially starting some positions in Enphase, but I like it under $100, guys. So if we get continued tech weakness, which brings down the entire market and everything with it, and we can find Enphase under $100 again, that's where I might be willing to take a little stab at it and hold for that long-term industry recovery, right? The valuation right here is a little bit high, even at 116. So PE ratio at 116 is about a 41.7, a little bit high. And the PEG ratio at 116 is also a little bit high at 1.89. Get me below $100 pretty much, and we can find PEG ratios closer to maybe 1.6, 1.5 in maybe the mid $90 range. That would be a juicy entry spot for me. So I'll be keeping a very close watch on this one, because I don't believe the recovery of the stock is going to be an immediate thing. It is going to take some time, guys. So be patient with this one. I don't think there's any urgency, in other words, for Enphase, but I like the company. I like the business model, and we have to respect their status as the industry leader in the inverter technology, and renewables are going to be a big thing in the next 5 to 10 years. So that's pretty much everything for our earnings recaps, guys. Now let's get right into our technical analysis, shall we? So moving into the technical analysis, guys, the price action is going to be key right here. We have to recognize who is in control of the shorter term timeframes. And as of now, it is the bears, right? We were expecting lower high into maybe lower low rollover if we lost the hourly trend. And the loss of the hourly trend was significant as soon as the early morning, and just a waterfall drop throughout. Now, keep in mind, guys, we are approaching very oversold conditions on the 1 hour time frame and should maybe be due for a little bit of a bounce. I would not be surprised if the markets have a bounce tomorrow, but just recognize, what are we going for here, guys? We are just maybe looking for a lower high and potentially lower low conversion. So be very careful if we are to make some long attempts on a trading perspective. Be very mindful, guys, of your risk to reward. Usually your risk should be the lows pretty much if we're targeting oversold conditions on the 15, which they are extremely oversold on the 15 right now. You would have to go back a very long time to find the SPY at an 18 RSI in oversold conditions. As a matter of fact, you would have to go back all the way to the month of May, right, when they were back here, and you can see they usually tend to have have a nice bounce when we get under 20 on the 15-minute. I would not be surprised, guys, if we do get a little bit of a bounce tomorrow, but just understand what we are going for here. Maybe just going for a little bit of a bounce and maybe continued rollover. Also keep in mind, guys, we did flush through our area of support as of today, right? This big area of support we were counting on, lower end of that was 542, battling with the 50 EMA right now. That is now resistance. So this entire zone becomes resistance. Previous support also resistance too. So I would not be too greedy with my longs. If we were to take a long into tomorrow, let's say we get 1-2 days of recovery, guys, be very mindful of this location. 548 may just be case in point for a rejection and maybe revisit of the lows. The bears are in full control right now, have all the momentum, and could be some significant selling to continue to be had over the next couple of weeks, because we know we are in full weekly consolidation mode, coming off extremely overbought conditions on the RSI, and maybe just due for a little bit more weekly sell-off like we got back here, or some extended sell-off like we got in the last fall, and this one would be more specific to the election cycle. So just be very mindful of who's in control right now. Yes, your long-term bulls are still in control, but look at the monthly candle. Only a few trading days left on the SPY right now. I would not be surprised if this is the start of a little bit extended monthly consolidation, the bottom of which could potentially come into the 530 down to about 516. That will be top to bottom sell-off on the SPY of about 8%, right? 6 to 8%, which is usually what you have in a larger form sell-off, verging on correction. Correction will be about 10% plus. I do believe that the SPY could hit maybe 6 to 8%, maybe not in one clean shot, but definitely, guys, keep a close watch on the price action, right? It's going to be absolutely crucial. So moving on to the QQQs right now, QQQs, exact same analysis. Who is in control right now, guys? The bears are in full short-term control. Very aggressive downswing right now. Waterfall drop, guys. Take a look at your 5-minute. Do not try and take buy opportunities if we cannot even set a 5-minute uptrend. No 5-minute uptrend to be had. So you should not be looking for an hourly bounce until we at least get a 5-minute uptrend recapture. No matter how oversold the conditions get, guys, these are algorithms just smashing the bid all day. Be very careful of it, right? Not normal price action on a day like today. So if ever we do get a bounce, guys, keep in mind our RSI levels leading in the close, extremely crushed, got all the way down to the 14 on the 15-minute, and even on the 1 hour, guys, absolutely crushed in the low 20s. Usually we don't get to the low 20s. Last time was once again at the end of the month of May, and early on in the month of April as well, we got all the way down to about 14. So the QQQs can definitely have a little bit more sell-off in the mix here, guys. So be very, very attentive to that. Let me take a look at the futures right now. Futures actually hit massive oversold conditions. So there's a discrepancy right now between futures and the S&P and the QQQ, just because we have that overnight selling pressure, right? So because of that, the futures levels are actually a lot more sold off, which leads me to believe that even though the QQQs can have a little bit more to the downside tomorrow, if ever we get a gap down open, guys, that might be a good entry for some potential buys, right? Gap down into further oversold conditions could put us at very, very low RSI levels and could be a nice condition for a bounce. But once again, as soon as the market opens, guys, if we gap down, please, please, please wait for your 1-minute uptrend recapture to try and make a trend attempt, right? Or a trade attempt rather, because it is a counter trend trade. As soon as we resume, if let's say we get a little bit of a bounce tomorrow and in the Friday session, just understand we're just looking for a lower high for maybe a lower low setup, right? All this area above us, previous support is now resistance, 480 down to about 472. So if we pull back into this area, guys, I'd be highly surprised if we get the V shape. For the V shape, we would need beautiful, amazing tech earnings next week. And if we don't get those, guys, expect continued roll over by the bears. Now, on the weekly, full weekly consolidation, weekly uptrend is still in motion. Still just looking for a weekly higher low, anything above 442, looking for that weekly higher low. However, if the bears take back too much of this, guys, could just be expecting maybe for at best a tightening range. Worst case scenario, a weekly downtrend rollover similar to last fall, which would lead us into further monthly consolidation, guys. We've now given up the entire month of July gains. Look at this monthly candle. Could just be in case in point for some potential monthly consolidation, the extent of which could bring us back into this big level right here, guys. April levels, right? 449 down to about 434. This is where the pain might stop, in my humble opinion. That would be a top to bottom drop of anywhere between 10 to 13%, roughly the exact same that we got last fall. So be very mindful of this area. We're doing it a little bit quicker this time around, but we could just see something like this, right? Some bounces in the mix and then eventually taper off into these lower levels. Moving on to XLF financials right now. So financials also rolling over. Daily downtrend started on financials, had a beautiful upswing right here, and unfortunately gave it all back. A lot of the fault of that is unfortunately to Visa's earnings. I still do maintain, guys, You're never going to get me off this one, guys. Visa is one of the best companies in the market. MasterCard is as well. If we're not buying dips on these companies, some of the most solid companies in the world right now, what are we even buying dips on? What are we even doing in these markets, guys? If we cannot comfortably buy dips on Visa and MasterCard when they have 50% plus net margins and EPS and revenue expansion and just such a solid business model as a whole, right? Then we can't say that we're really investors, can we, right? So Visa, I maintain this one, still remains a buy opportunity. If we come down lower, MasterCard and Visa, I will be buying the entire way down. Trust me on that one. When you have a long-term chart that looks like this one, guys, it should just be a buying opportunity. Any extended consolidation, guys, from an all-time high down about 12% has always been a good buying opportunity for Visa in the past, and I don't believe that's any different. That's definitely the one weighing down financials today. So daily downtrend embarked on financials. Keep a close eye. Coming up on the first level right here, 4240 prior all-time high resistance should be newfound support. If we just blast through this one, guys, keep an eye on your weekly timeframes, and the weeklies have a lot of space. Anything above 40.5, just looking for that weekly higher low for continuation of the uptrend. The damage really starts to stop pretty much, in my humble opinion. 4163 down about that 40.61. This is where a lot of long-term bulls are sitting, and on the long-term price action, guys, still in a bit of a monthly tightening range at the all-time highs right here. Financials should perform very well, coming closer and closer to that interest rate cut. Now, moving on to XLV Healthcare. XLV Healthcare outperforming the entire market today. Daily uptrend still in motion, still looking for the continuation with the break of the all-time high, 151.23. If they cannot get it done, guys, and we just consolidate further and roll over the daily as well, just keep in mind, guys, if we do get that daily downtrend, weeklies do have a lot of space. Weekly uptrend is nice right now. One of the sectors that's been highly in favor as of right now. Keep a close eye on AbbVie's earnings tomorrow. Your very big healthcare players have earnings tomorrow morning, so they will set the tone, you guys. Remember what happened with UNH earnings last about a week and a half ago at this point, right? Blow off on earnings, and a lot of healthcare companies have been performing very, very well on earnings. Johnson & Johnson also has a very, very good earnings cycle, so you can see the rotation into healthcare, guys, right? So just be mindful of that. Could be a continuation of a bullish sector play into the next coming months. So looking very good on healthcare, tons of space to pull back on the weekly, and the monthly at this point is looking still good for trend expansion. Moving on to semiconductors right now, something that is not looking too good, right? So semiconductors, clear daily downtrend, guys, and we were wary of that after losing the hourly time frame yesterday. I was telling you guys, if we were to lose the hourly time frame into today with such a weak daily bounce, the rollover would be almost guaranteed, and that's exactly what we got, right? So daily downtrend continues at this point. Looking on the weekly at this point, guys, maybe for some weekly downtrend follow through, right? I am a big proponent of this weekly consolidation, guys, right? Not to say that I don't like the semiconductor industry, but they've ran a lot, way a lot, in my humble opinion, right? Monthly overbought conditions, we know it can last a while as it did in the past, but we have to respect the monthly overbought conditions. Weekly, heavily overbought conditions, normalizing right now as well. So just a little bit of normalization in my humble opinion. Daily downtrend, as soon as we get a bounce, probably looking for a lower high into lower low. As soon as that bounce starts, you guys know the rules. Hourly uptrend denotes your daily bounce is underway. Then we watch the size of the bounce. And if it's too weak, like this one right here, well, in relation to the move, right? Well, then we may just be due for some extended daily rollover. Where could that potentially bring us, guys? This first weekly leg down of consolidation? Well, the previous all-time highs would be a good point to start, right? And that pretty much starts, we're almost in it, 240 all the way down to about 226 is going to be a likely area where the bulls put up a bit of a defense. And however, if we come into there hard, may just be a case in point for a weekly lower high and maybe weekly lower low as time moves on into August and September. So be very mindful of that. Monthly consolidation is definitely underway. A lot of space on the monthly still, though. Anything above 199, looking for that monthly higher low for maybe some trend continuation. But we do have to normalize back down, guys. This sector is probably still out of favor for a while. There was some gorgeous setups, guys, that I really wanted to take, and I actually made an attempt on this one yesterday. I didn't show it to you guys. I took SMCI yesterday at the close, trying to bank on this support area for maybe a little bit of rally, and unfortunately, they just rug pulled us today, right? So really coming below, I had to close because the invalidation point was right here at 740, so my stop loss was 740. Invalidation point now trending lower. So that was a beautiful setup, but unfortunately too much, right? A lot of companies still very rich in this sector. ARM still very close to its all-time highs as well. NVIDIA still very relatively close to its all-time highs, even though the company has pulled down a lot so far recently, right? We are still relatively close to the all-time highs. 15% away. This one can move a lot, so be very mindful of that, guys. A lot of semiconductor plays do still have room to move to the downside, so be very, very careful with this index. And obviously, if you want to short it, you can obviously, or long it for that matter, you can use names like SOXL, which is the 3 times leverage long version of this, and XOXS, which is the 3 times short version of this. I will be using the XOSS version to play continued semiconductor weakness and writing short puts on my favorite companies way, way, way far out of the money. So that's the analysis on SMH. Moving into IWM Russell right now. So IWM Russell also manifesting a little bit of weakness. They were holding up better than the rest of the market today, but really came undone on the end of the day. So on the watch for this daily downtrend, that will be a break of 215.22. Daily downtrend would be underway, and we'll be in for a bit of weekly consolidation. Completely normal, guys. We ran up extremely strong into our massive area of resistance. So normal that we're getting rejected on our first attempt right here. If we continue this downside momentum, where could it potentially take us into? Well, keep in mind, guys, the weekly support level is right below us right here. 210 all the way down to about 207 is going to be that first line of defense for the bulls. So keep a close watch on that. Still in a very nice weekly uptrend. Keep a close watch on how we react to this level. If we just blow through it, guys, well, then probably looking out for the weekly lower high and maybe further consolidation. But if we react to it nicely, may just be due for a second attempt and then maybe some consolidation if they can't get it done once more. IWM, though, holding up better than most. Moving on to the Dow Jones. Dow Jones down. Daily downtrend underway again. We were on the watch for that yesterday, right? Loss of the hourly time frame. Struggling in the end of the day, loss of it today. So you guys know daily downtrend rollover is underway, which means we are in weekly consolidation right away. So weekly uptrend is very nice right now. Still a lot of space, anything pretty much above 38,000. Just looking for a weekly higher low for potential trend continuation. Weekly 12 EMA is right here, 39,400. And what else is there? Our next area of previous resistance, which is now going to be support. Daily 50 EMA is there as well. So may just find a reaction in this lower zone as we enter. Then it'll be crucial to watch the size of the bounce if you want the bulls to recapture this for more of your defensive and value names. So we'll be on the watch for this bounce setup in this lower location right here. As of now, bears in full short-term control. Obviously, guys, the VIX, we got to be very careful of this. Same thing happened last April and same thing happened last October. Usually we do get peaks in the 20-22 range on the VIX right now, and we're pretty much halfway there, right? These days will not last forever. Usually have back-to-back brutal days like this, and then it kind of trickles off, then a bit more, right? You saw how it happened in the month of September and October. It's really not streamlined. I'm not expecting the VIX to really raise to prior levels back here. That would just be crazy in my humble opinion, but be on very special watch when we do have heightened VIX. Technically, things do tend to move a lot more, which is why I say whatever you think the expected move for a given week is now, guys, at least 1.5 to 2x that, and that will probably be the real expected move. Now, let's move into it, guys. So moving into big tech names, shall we? So moving into big tech, guys, Apple down about 2.88%, really coming into our big area that we've been on the watch for, right? Previous resistance should be newfound support. We are literally right there. Reacted nicely on a first touch from it today, but in my humble opinion, if this momentum continues to the downside, guys, Apple is not going to be saved, right? Keep an eye, hourly oversold conditions, so it could just be due for a bounce, but we are expecting a lower high, and then it's up to the bulls to protect these lower lows, or we just risk the eventual rollover. Daily downtrend fully controlled by the bears right now, which means we're in larger form weekly consolidation. We were saying watch the loss of this 12 EMA for a loss of a daily uptrend, and exactly that is what happened, right? So Apple on deck with earnings next week, more specifically next Thursday. So limited price action until then, but what I want to see Apple hold is 207. If they cannot hold 207 before earnings, guys, it's going to be dicey. If they do have a earnings report that's decent but not up to expectations, we could maybe even see a retest of the lower levels. 200 down to about 195. That is where I would be more willing to play Apple specifically, because then from the all-time highs, you'd be talking about a dip of about 15-16%. Usually those are good buying opportunities on Apple. As of now, though, short-term bear momentum is well in play, and we are just expecting off of any bounce, maybe a lower high, and maybe resumption of the daily downtrend. Further weekly consolidation, and maybe a little bit of monthly give back into the month of August, rolling over into this level right here, looking for the monthly higher low for further trend continuation. So good, healthy consolidation in these markets. Moving on to AMD right now. AMD definitely not having a great last 2 weeks, guys, right? My heart goes out to everybody. I was in this one as well, and I unfortunately had to cut my positions. right earlier in the week right here. Happy that I did, because if I did not, we would be down a lot today. So AMD moving another 6% to the downside. Daily downtrend momentum is just too strong. We were saying the bounce size was very, very weak yesterday, running in this area as resistance, and resistance proved to be true, and now we are just rolling over. So we're rolling over, guys, into the last line of defense for the bulls, in my humble opinion, which is 141 all the way down to about 142. AMD has earnings, guys, next Tuesday, so very limited amount of days of price action, right? What I need to see from the bulls, guys, we need to protect this area prior to earnings to at least give ourselves a chance, right? Usually expected move on AMD earnings is about 9-10% to the downside, right? If for every which reason we just blast through this area right here and get another 9-10% to the downside, it's not going to look pretty, guys. We're pretty much eyeing at that point, right, you know, to lower end of this, about the 130 mark before we are at the lower end of that support range, which is why I say it's so crucial for them to end above. However, daily bears are in full short-term control right now. Keep an eye on your hourly, right? A little bit of hourly divergence right now. So this is what's known as bullish divergence. Usually this does lead into a little bit of a turnaround, right? When your RSI is pointing up, but your trend is pointing down. Usually it does repoint in the direction of the RSI moving up. So we could have a short-term bounce, but just be mindful, guys. As I've said, any short-term bounce is probably just for a lower high into lower low. So manage your risk accordingly, guys. Big support level, need to see how it reacts to this zone right here, because you guys don't want to hear the levels that are under that, right? Your next support range under that comes all the way down to about $105, $100. So they really need to do a good job of holding this one up. If not, we come into lower price levels. I think they got it, guys. I think they have it in the bag, but obviously in this type of market, anything can happen, right? So be very cautious on your positioning on AMD. Love the company, love what they're doing. Just a little bit of an industry-wide drawdown right now. No fault of their own, because their own earnings are going to be glorious in 2025. So as a long-term investment, I still like this one. Just short-term price action may not be too favorable for the bulls. Moving on to Amazon right now. So Amazon continues its decline, unfortunately, looking for the lower low. Lower low is right here, 180.55. If we roll that over, daily downtrend simply continues, and we just look for furtherance of the weekly consolidation. Weekly higher lows are right here, guys. 175, lose 175, you lose the weekly uptrend, but Amazon can have a chance to recover it thereafter if they have decent earnings, and their earnings are pretty much next Thursday. So be very cautious about their earnings next Thursday, guys. Usually they move about 7%. So if we were to maintain these relative levels before their earnings, 7% would pretty much put us at the bottom of that range right there. That would be a top to bottom decline of about 17%. Usually has always been a good opportunity to buy Amazon on a 17% decline, as seen by the last October sell-off, and even the one that happened in the month of April, 11-12%. Usually a good time to buy Amazon. Huge support below us, guys, right? So this whole 177 down to 165, extremely solid support on the weekly. Recent history, yes, but prior all-time highs, guys. The bears are not going to be able to get through this one very easily, in my humble opinion. Amazon's going to have a record year this year, and it's going to be very tough to dislodge investors off of their pristine fundamentals and free cash flow and net margins this year. So keep a close watch on this location right now. As of now, hourly time frame not yet oversold, and 4-hour conditions barely oversold as of yesterday's trading, but now more manageable. So Amazon definitely does have a little bit more room to follow. I will be looking to play it, guys. Lower 170s, mid 160s. I am going to go heavy on Amazon. Moving into Google right now. So Google also looking not too bad, even though they were down 5%. The reason I say they're looking not too bad, guys, is because who is in control in terms of the longer time frames, guys? The monthly, right? Just healthy monthly consolidation, in my humble opinion. We went through their earnings yesterday. They were not that bad. So yes, even though they do have a daily downtrend in motion right now, we are teetering on the lower end of our current support box, which ends at about 171. And below that, guys, you're pretty much going for the prior earnings gap fill all the way down here at about 160, right? So be mindful of this area. If not, we're probably targeting that 160 range. Now, if we get all the way down to 160, could be a great buying opportunity. That would be a 17% decline for Google off the all-time highs, similar to what we had in January. That was a great buying opportunity, similar to what we had last October, 13%. That was a great buying opportunity, guys. So looking very good for Google, in my humble opinion. If we do continue these declines into the mid 160s, I will be buying very heavy. Just be mindful, short-term bears are in control. If we do get a little bit of a bounce here, guys, because of short-term oversold conditions, Google is definitely oversold on the 1 hour, slightly oversold on the 4 hour as well. So we could be getting a little bit of a bounce here in the near term future. However, keep in mind, guys, Support above us is now resistance, so could be likely to get rejected and move on to lower lows and just continue this daily downtrend onslaught until the bulls put in a sizable move and reverse this, right, in the entire market. But we're going to be watching that one day at a time, just giving you guys longer term levels. Moving on to Meta right now. So Meta also, down 5.61%. They're really pretty much moving down with the entire tech industry. No secret there. So unfortunately, Meta guys, even though they had a very juicy bounce, could not counter the broader market sell-off today. So teetering near the lows right now, 458. If they crack this, daily downtrend simply continues and looking for continued weekly continuation to the downside, right? Weekly consolidation still underway. Weekly uptrend has officially been lost as of last week. The higher lows were right here, but not in a weekly downtrend yet. Weekly downtrend would be lower high into lower low. They lost the weekly here too, right? This was a nice weekly uptrend, flush, and then they took a while to get it back, right? So they can do a similar thing to where it just takes them a little bit longer to get it back. They have earnings pretty much next Wednesday. Be very mindful of next Wednesday's earnings, guys. If Meta, for ever which reason, comes down back into this lower level right here, 430 all the way down to pretty much 410, I will be heavily buying Meta, 420 all the way down to 400 pretty much. This sweet spot right here, going to be a very nice buying opportunity on Meta in my humble opinion. Their fundamentals are amazing. That would represent a 24% drop from the all-time highs on Meta, and similar to pretty much what we had last summer, pretty much 17% declines. Has to be a buying opportunity for Meta. Not the same company as it was back in 2022. Their free cash flow and margins are insane right now. Company is still growing well. Just need to be mindful of the advertising business. So far, no slowdowns really. Google also didn't really voice any concerns for advertising slowdown that much. So I'm not too worried about Meta, but you guys know the market that we're in right now. Just be mindful for earnings. So this one I will be playing more aggressively. If we come down lower 420 to about $400, the valuation down there will be extremely good. And even the short-term price action in terms of percentage from the all-time highs will be excessively juicy as well. So pay close attention to Meta if ever we start losing this lower end of the support. Now, moving on to Microsoft. So Microsoft also, daily downtrend simply continuing right now. Lower low has been set in motion. So Microsoft, not yet daily oversold right now. On the 1 hour, 1 hour is oversold. So maybe just a short-term bounce, but just be mindful, guys. So much overhead with support, previous resistance. The moving averages are above us right now. May just be lower high, lower low capacity for your bears right there. Right? So Microsoft now down in terms of total from the all-time highs, about 8%. The extent of the damage, guys, you could take a look back in April. They went about 10%. You could take a look at last fall as well, top to bottom. That was about 13%. So if ever Microsoft continues its decline and brings us into this lower channel, I've since erased it since we moved out of that channel, but the channel is still very clear, right? It's really this channel right here, which we're kind of moving back into ever so slightly. So if ever we come back into this channel right here and start testing these lower support ranges, think maybe 412, think especially 400, that would be a significant sell-off for Microsoft top to bottom. That would be about exactly what we're looking for, guys. 12 to about 14%. Plus big lower range support, big support back on the weeklies as well. So just keep that in mind, guys. Weekly consolidation is underway. The weekly higher lows are right here. Similar to Meta, we can lose this and then it'll take them a while to recapture it, right? So unless I see weekly downtrend, that's when I really get worried. As of now, no sense of that. It happened slightly last October, ever so slightly, but you saw they were able to recapture it. So not too worried as of yet. Current support level, we're approaching it, right? All the way down to about 423. We're in it right now. Big resistance, current support. But if ever we just blast through it like it's nobody's business and set up for maybe a weekly downtrend in these lower levels, this is where I'm looking to pick the bottoms on Microsoft. 410 down to about 400. No brainer buy opportunity in my humble opinion. Moving on to Netflix. Netflix down about 1.05%, holding up better than most companies out there, right? So Netflix really teetering in to our big support range, 635 down to about 605. Huge prior congestion area, big support as well. Should be big support for the company too, right? So daily downtrend is currently underway, watching for a break of this candle right here, the earnings candle 429. That would just be daily downtrend continuation. That would just be extended weekly consolidation, right? In jeopardy of losing the weeklies right now, 625. Break that, and unfortunately, we have lost our weekly uptrend and may just be setting up for the weekly lower high into maybe lower low momentum, right? Or if anything, if they only just flush, it just take us some time to recover that. Similar to right here, it took them a long time to recover the weekly uptrend, right? So all in all, Netflix not looking too bad. One thing's for sure, if for whatever its reason we come all the way down and breach 600, I will be looking to acquire some shares. 580, 570 seems to be like a great location for some Netflix shares. Just looking for a monthly higher low for continuation of the monthly uptrend. Looking very good. This prior area, guys, right? That whole 580 down to about 550. So solid. I would be highly Highly surprised if the bears can get through that. As a matter of fact, let me just move this up here so it makes more sense, right? Huge prior area. That is the last line of defense for the bulls right now. That'll be a 17 to 24% decline. There's always been a good opportunity to buy Netflix when they've had those declines ever since they've started this most recent bull run. Moving into NVIDIA right now, give me a quick second. Moving into NVIDIA, so down about 7% today. NVIDIA definitely does have more room to fall, guys. I'm sorry to say it. I'm just saying it. I'm just viewing it how it is, right? Just in terms of the technicals, they do have more room to fall. Daily oversold conditions are not yet met. 4-hour oversold conditions are not yet met. Even 1 hour oversold, barely 1 hour oversold. So if we do see some short-term price action recapture tomorrow, let's say we get a little bit of an hourly uptrend going, a little bit of a bounce, I do expect that we're maybe just looking for daily downtrend, lower high into lower low. Be very careful. Now we're below the 119 to 114 support. We're now below that. So if we move lower and then bounce, we're going to be using this area as resistance. Could just be a case in point for lower high into lower low continuation on NVIDIA, which would mean that weekly downtrend is simply continuing. I've said it once, I'll say it again, guys. Where is my desired location to be buying NVIDIA stock? Where the valuation is more manageable and where the price action is more manageable, it's pretty much 105 down to about $95, right? If they come down there, it'll be a great level for your longer term bulls. Gorgeous monthly uptrend, looking for a monthly higher low for some continued price action. Top to bottom declines, if we come down there, 26 to about 34%. Usually always a good buying opportunity. In the month of April, they went down 23. And last fall, I'll remind you, they went down about 20, 22 as well. So that would not be out of the norms for NVIDIA to drop, 23 to about 25% to the lower end of that. That is going to be the area that I'm looking to play NVIDIA more aggressively, in my humble opinion. So that is just a fact of the matter on the stock. And obviously, we're not talking about bull locations, guys, but if ever you guys want any of these stocks to have a reversal, you know what needs to happen. Need to have a daily move, at least a 618 retracement of a daily flush, and then set up for the daily trend change. Only then can we say that the weekly momentum of the downside is stopped and we're looking for a bounce on the weekly. And then same logic applies, size of the weekly bounce into maybe further uptrend. But as of now, bears in short-term control. Moving on to Tesla right now. Tesla down about 12.33%. Definitely not having a great day at all, right? Coming very quickly into the area that we were talking about yesterday. 205 down to 200 is going to be the big one. So obviously daily downtrend is clear as day right now on Tesla. Really did a poor job of pushing back the robo-taxi event. It killed their momentum, guys. Straight out killed their momentum, right? So now still a weekly uptrend, looking for a weekly higher low, but be very mindful, guys. Be cautious because right now we've pulled back a lot, over 50%. If you were to pull back all the way to 200 or lower, that would be a 618 retracement, and it doesn't leave the bulls a great opportunity to V-shape this. If anything, it leads us to, at best, a consolidation tightening range, at worst, a weekly downtrend setup leading us back into the 180s. So those are the scenarios that are on the table for Tesla right now. I will not be touching this one personally just because the earnings did not give me any immediate confidence yesterday, guys. Earnings yesterday were great. If you're a long-term Tesla investor, the focus on Robotaxi, on Optimus, on Dojo, on the 4680 cells, everything on energy storage, everything for the long-term portion of the business was very, very bullish yesterday. But for the short-term demand of their EVs, that was not discussed on the earnings call yesterday and was a mistake by management, in my humble opinion. It's good that they're focusing on the long term. I commend them for that, but you at least have to address short-term concerns. I don't care if you only address them for 2, 3, 4 minutes, but at least say something. Say what you're going to do moving forward. They did the 0.99% APY financing for Model 3 and Model Y users. Model Y was 1.99 actually, but they did financing incentives for consumers to stimulate demand. So I was curious to see on the earnings call, do they have any more strategies for us to stimulate demand? Are they going to go back to that interest rate pricing? Are they going to do some advertising? Nothing was said, guys. So still very short-term uncertainty for Tesla. I love the company. I love the long-term endeavors of the company, but short-term, guys, they're really, in a cyclical business that's unfortunately affected highly by interest rates right now. So big momentum to the downside, nowhere close to daily oversold, just because we're coming off such highs right there. 4 hours, not oversold just yet. And even on the 1 hour, guys, yes, 1 hour oversold. So could we maybe see a little bit of a bounce on Tesla? Yes, but just be mindful, guys, just going to be looking on the daily for a lower high attempt, maybe about 230, lower high attempt as high maybe as 240. Previous support going to be current resistance, lower high, and then probably revisit the lows or flush the lows for some continuation momentum to the downside if tech continues being out of favor. As I said, guys, I'll be more interested in this one if we revisit the lower 180 range. Now, lastly, Palantir, guys. So Palantir, unfortunately, Falling off now, we were being very careful about this one, right? Getting rejected continuously at the 29-28 level. No fault of the company on its own. Huge level from 2020 and 2021. A lot of trapped liquidity up here. A lot of investors just pretty much selling their gains right there and contributing to the stock coming down. This one, obviously, momentum led to the downside by your big tech flush. So they got caught up in the mix. Now, unfortunately, guys, daily downtrend is underway on Palantir. Now quickly approaching my zone of support. 26 down to 25 should be the first line touch. Previous resistance should be newfound support. 50 EMA is right there as well. So could just be getting a little bit of a bounce, but the size of this move, guys, probably going to be followed with a lower high, and then it's up to the bulls to prove to us, can they maintain this? Or will we get the lower low flush and maybe start revisiting the lower 24s, $23 levels down there? That would be in the context of a weekly consolidation move, which should just blast past the support with overall tech weakness, send us maybe a little bit lower. But I like Palantir, guys. 24 and lower, 24, 23. I really like them in terms of long-term growth prospects. And obviously that could be a first level, but if ever it gets really bad and we revisit the lower 20s, like 22, 21, that is where I'm going to be really going in with a lot of size on Palantir. Long-term though, looking still good. Monthly uptrend, maybe just due for a little bit of a pullback, guys. We have had, I know it doesn't seem like it, but we had to have 10 weeks of rally. Could just be due for a little bit of extended pullback. That's pretty much everything I had for you guys today. So, as I said, guys, just focus on what we can control. And that is pretty much everything we went over at the beginning of the video, right? Focus on what we can control. Nobody has a crystal ball, guys. Nobody knows the extent of the drop, when it's going to stop, the exact date it's going to reverse, how big the size of the bounces are. Focus on what you can control, depending on whether you're a long-term investor or a trader. Focus on these things that you can control. Stick to your strategy, stick to your long-term buy strategy, or stick to your trading strategy specifically. This is the last time you want to deviate from that, trying to chase the market, trying to get overly aggressive, over trading, revenge trading. Do not do any of it. If anything, guys, just sit patiently and wait for good companies to come to you in the locations that we've described in the videos. So hopefully that makes sense, guys. If you enjoyed today's video, consider dropping a like. Would really appreciate it for the growth of the channel. Consider subscribing to the channel if you're new as well. Would love to have you here. We do these every Monday to Friday after the close. And lastly, if you have any questions at all, guys, especially on a day like today, please feel free to leave them down below in the comments. Anything you want, stocks, technical analysis, macro discussion, especially macro discussion, options play, strategies, anything you want, leave it down below and I'll be happy to engage with you. Usually answer in about 24 hours. I'll do a lot of comment answers tonight, so feel free to leave them down below. Take care, guys. See you tomorrow. Keep your chin up, head high. Let's focus. Let's stay locked in. Do not let your emotions overpower your strategy or your investing thesis, right? None of the fundamentals on any of these companies have changed for the most part. So just stick to your thesis, stick to high conviction companies. Don't let your emotions take over, guys, because that's when we kind of lose the whole game, right? So stay focused, stay locked in. I love all you guys. This is just going to be a temporary little dip here, right? It may last for a few weeks, up to a month or something like that. We will get through it as we have every single one before, and I'll be there to take you guys through it every step of the way. So take care, guys. See you tomorrow, and peace.